Hello, everybody. Luke Gromen, FFTT. Hope you are well. Thank you, thank you, thank you. Thanks for joining us for another weekly or bi-weekly update. Really appreciate you joining me. Thank you for the questions, as always. I'm going to jump right in the interest of time. First question from NT. Will Trump and company hold the line on government right-sizing and fiscal responsibility? If they do, is this train in trouble, as in nothing stops this train, as our friend Lynn Alden likes to say? And 3, will Elon survive this historical phase? In my opinion, will they hold the line? I don't know. As I went to press here now, I saw a headline saying Trump saying, well, maybe we'll balance the budget in 2026. So maybe pushing off a little bit as he sees the true cost of trying to do that. Will this train be in trouble? Either way, no. Ultimately, if they back off, then away we go with the train. If they don't back off in terms of austerity, they're going to likely force a recession, and due to the drop in government spending, because government's 25% of GDP, and marginal consumer spending is driven heavily by stocks, and stocks obviously are not reacting well to potential austerity, as we've seen year to date. And so you will likely see receipt declines of a magnitude that actually drive deficit increases despite the austerity from DOGE, which I think will be highly politically discrediting, and more importantly, will keep this train rolling. So the last question, politically, I think Elon Musk is going to have a hard time politically dealing with the fallout if DOGE cuts lead to a recession and an increase in the deficit, which I think is likely to happen if they cut too much, all else equal. So, but I think financially, etc., he'll be just fine. From BT, days when the S&P goes up, down, round trip 2% are always interesting and not caught in the long run typically. What is your view on volatility VIX in the next quarter or so? I think VIX is going higher, and I think it's going to stay elevated. There's political uncertainty, geopolitical uncertainty, investing uncertainty from both an investor and a corporate deployment of capital standpoint. There's capital flow uncertainty with the Trump administration essentially telling foreigners and especially the Chinese, take your ball and go home. So I think vol is going to remain elevated for that at least next 2, 3, 4 months. From MW, hey Luke, I just saw Scott Bessent saying things that you were saying months ago. For your upcoming video, can you comment on what caused the strength of the dollar between 2011 and 2022, while global central banks were not buying any new treasuries on net, but moving $600 billion into gold? Thanks, and keep up the great work. Thank you for the kind words. In essence, the U.S. government was crowding out global dollar markets. Central banks, price-insensitive buyers of treasuries, they stopped buying on net in 2014. Government debt issuance kept rising. And so as that happened, you crowd out global dollar markets. That drives dollar up, rates up. As rates go up and dollar goes up, foreigners who have borrowed $13 trillion in aggregate in dollar-denominated debt start selling assets to raise dollars to service that debt. And that continues until you have some sort of mini crisis, and then more dollar liquidity is supplied. Wash, rinse, repeat, and that's the process we've been seeing. So that has been what we have seen, and that was the mechanics driven by foreign central banks stopping growing holdings of treasuries as they did 11 years ago. From Dylan, so it seems like everyone is in agreement that a big print is necessary, but how long can they kick the can? I believe I saw Larry Fink say he expects 2025 to be rocky. So it is your base case that they let the economy look ugly for a year or two and then print their way into midterms. What we've called true interest expense, which is entitlements plus interest, is over 100% of receipts now, with receipts near all-time highs. Receipts, if you start cutting government at 25% of GDP and you hit the stock market, which is starting to happen, you will drive receipt declines. And so you don't have a year or two. They don't have a year or two, in my opinion. Question, I guess, now is how long are they going to let markets twist in the wind, so to speak, and will they allow treasury auctions to start to get dysfunctional? If no on the auctions, which I think is still a pretty good bet, uh, then I think we probably get some sort of a resolution, liquidity, what have you, uh, and maybe outside the currently accepted Overton window of solutions, some sort of gold revaluation, etc., as has been bannered about recently. I think we get that in the next 2 to 4 months. I don't think they have a year or two. So let's watch and see. Things are certainly getting spicy in the last several weeks, and I think it's going to continue all else equal. From Ronan. Hi, Luke. What's your view on the claims by StoneX CEO in mid-February that 2,000 tons of gold had been imported into the U.S. over a 7 to 8 week period spanning December 24 to mid-2025? I think it's very interesting. I posted on X today. I think the most interesting thing about all these gold imports is who's selling dollars in size and buying gold and why. And I don't know that anybody has a great reason that is not speculative to either of those questions. I have no way to refute or deny the 2,000 ton estimate. I will say that directionally, that has that estimate size dovetails with comments made by our friend Josh Philip Fair at Scottsdale Mint recently, and I'd check out his posts on X on that topic over the last month or so. So I think it's interesting. I think it's important. And, we'll see. Let's watch, as I like to say. From AP, hi, Luke. Thanks for your insight as always. You're welcome. Thanks for joining. In your view, how might the nearly $7 trillion in money market funds be significantly incentivized to flow back into U.S. equities? I presume lower rates, lower equity prices would be a start. Are there any other factors to watch? I think it's a really good question. Obviously, Yellen shifted issuance to the front end because that's where the demand was. That's where she could place that much paper. And so this money sitting in money market funds is a lot, if not all of it, is in T-bills now. So it's helping finance deficits. So in theory, you would need, if you move that out of short-term paper, you'd need to move it to long-term paper. But I think the preponderance of the evidence suggests there is no way that Besant could term out anywhere near that much into the longer-term markets without blowing out rates, which would hurt the economy badly. So you'd probably need some sort of restructuring of the debt, revaluation of gold, buying down of the debt, etc., before you could really start to move that liquidity out of T-bills, where it's financing deficits at the short end, into equities, etc. In my opinion, as I think through it, kind of here on the fly. Next question is from BL. What's driving the dollar lower? How does that connect to the drop in the 10-year Treasury yield? Curious to hear thoughts on how this impacts monetary hedges like Bitcoin and gold, and how does it link to the $6 trillion that need to be refinanced this year? In short, it's capital outflows. If you look at the actions of the U.S. under Trump, they've been essentially saying, take your ball and go home out of U.S. capital markets, be that telling China to get out of the Panama Canal, etc. But most explicitly, if you haven't read this America First Investment Policy memo, February 21, 2025, signed by Trump, very late Friday night, February 21st, I would stop what you're doing and I would read it. It essentially tells China, take your money and go home. And that looks to be like what's happening. Dollar down, NASDAQ down, S&P down. And so far, we've had the mechanical benefit to 10-year Treasury yields that has persisted over the last year and a half of 10-year yields down when the dollar goes down. But that correlation today is starting to break. We're starting to see 10-year yields up with the weaker dollar. So that's dollar down, stocks down, bonds down. That's capital outflows. It's been a long time since we've seen anything like that in the U.S. It's something pretty common in emerging markets. But it's ultimately, I think, part of a broader plan by the Trump administration. If you want to restructure the system, you got to stop having China store their surpluses in your stock market and your bond market. You got to send it into something not dollar related, gold or somebody else's stock market. So let's watch. From JB, Luke, longtime FFTT subscriber here. Thank you very much. If it's legal to improve the national debt picture, why doesn't Besant simply issue the order to revalue U.S. gold holdings up to market or even higher? I think it's largely dogma. I would suspect he's probably trying to see what other levers he can pull before doing something so far out of the Overton window. My opinion is he doesn't have enough levers. They waited too long. Eventually, that lever is going to have to be pulled in some way, shape, or form. But let's watch and see. From GB, someone said that they don't think U.S. gold is there as a safety hedge for the dollar, and that the only reason they wouldn't have sold it if it's there is that it's left over from the past system. I think that's BS, but would be interesting to hear your arguments of the other side. I think it's there. I think the gold is there still because it's the only thing to go back to whenever the dollar system, as it's been structured since 1971, outlives its usefulness and outlives its usefulness to the United States, which is something has always been known will occur at the highest levels. And it's also known at the highest levels that nobody else wants to take the dollar's role post 71. You hear somebody saying, oh, the Chinese yuan's never going to overtake the dollar. No kidding. They don't want it. Why? Because that means they would have to hollow out their defense industrial base. They would have to offshore all those factory jobs. They would have to run up their debt. There's zero chance they want that. They do not want that. The only thing to go back to, you always hear what's going to replace the dollar? Gold is replacing treasuries at the FX reserve level. It's been happening for 10 years in plain sight. It's likely going to continue to happen. So ultimately, I think that's why the gold is still there. From there, it's just a function of just a matter of price. From HO, it seems Bessent and Trump want to get 10-year yields lower via slower growth so they can enable / force the Fed to bring liquidity for COVID debt maturity wall coming later this year. Any idea what levels yield growth S&P could be satisfactory to them? In my opinion, they are threading a very narrow needle, very narrow. U.S. debt this high, with foreigners owning $13 trillion in dollar-denominated debt, long $22 trillion in dollar-denominated assets net, including $8.5 trillion in treasuries. You get stocks too low, you're going to get a recession, you're going to get a blowout in deficits as receipts fall, you're going to get yields up in a recession. Too high of the dollar, you're going to get the same dynamic. Recession, deficits blow out, stocks down, yields up. Too low of dollar, inflation picks back up, American consumers eat the tariff inflation, yields rise. Again, problem. So it's a very tricky multi-body problem, narrow needle they're trying to thread. I wish them the best of luck. I'm glad it's not me. From Kai, one of the three arrows Scott Bessent speaks about is increasing oil production by 3 million barrels per day, which of equivalent, which seems incredibly ambitious. If producers do not or are not able to increase production, how will that affect the rest of Trump's economic plan going forward? The plans to both get oil down to $50 and ramp up production 3 million barrels a day of equivalent is one of several inconsistencies in Trump's economic plans, in my opinion. $50 oil, great, but 3 million barrels a day of equivalent is going to be doing a lot of the heavy lifting there. $50 per barrel oil is going to take a lot of existing shale offline. And so you're going to have to net increase way more than 3 million barrels a day by the end of 2028 per Bessent's target. Ethanol might get us there. You've seen some comments about that we've written about. Russia, maybe we do a deal with Russia and they count that number. It's barrel of oil equivalent. Natural gas to liquid, or NGLs, natural gas liquids. Saudi increases, who knows what they're including in there. But on just the merits of just oil, I think they can get 3 million barrels. I think they could get 50. I don't think they can get 50 and 3 million barrels, but let's see. From Zach, what's one simple habit you consistently practice for macroeconomic research? I know what the consensus view is, or I try to understand as best I can what it is. I know sort of where things actually stand relative to that consensus, and I know or trying to learn where things are changing on the margin relative to that consensus and where things are today. And when there's wide gaps between consensus and the other two factors, that's where the biggest money is made, in my experience. I also read people I disagree most vehemently with, probably more than I read things that I agree with. And I try to find things that would really crush my current views and positions to see where my blind spots are, to make sure that I understand both sides of the argument and really try to understand the other side of my view better than I understand my own view, or at least as good for sure. From Danny, you mentioned in an interview the Federal Reserve Accounting Handbook allows them to reprice gold and how it could help solve the U.S. debt problem. But wouldn't that make China, Russia, and other countries holding large amounts of gold immensely wealthy? Uh, the fact that they have bought all that gold means they're already immensely wealthy. It just hasn't been marked to market yet. Uh, Paper currency or debt that a government can print in the long run is never wealth. It's not sustainable wealth. And so, long run being the key word there. So yeah, it would, and it would just mark to market the surpluses, the wealth that they've already earned. And then finally, Adam, you have warned several times of DOGE kicking off a recession if the Trump administration doesn't devalue the dollar first or get debt to GDP down significantly first. Now, the 10-year yield is tanked, the yield curve's inverted, the GDP is set to be sub 3% or negative 3% per the Atlanta Fed. Is this what you were predicting, or is it too soon and this is due to other factors? No, it's partly due to this. There are some other factors at work on the GDP number at Atlanta Fed in terms of net exports. So U.S. companies front-ran tariffs by bringing in a bunch of product ahead of time, and so that mathematically, mechanically reduces GDP. But you're seeing other signs. You're seeing very weak job numbers, big layoffs from Challenger, Gray, and Christmas. Other signs of rapidly weakening economic indicators. The city leading economic indicator index, softest in 6 or 9 months. So, this is what we're seeing, and I think we're quickly getting to a spot where 10-year yields are going to stop going down, and that's where I think the real alarm bells will be going off in the White House and at Treasury when you get dollar down, stocks down, bonds down, yields up. That is not something that works for a highly levered economy, 120% debt to GDP, with a big refinancing bolus coming. That's where I think you start to get the increased chances of some sort of nonlinear or outside the current Overton window policy move, gold revaluation, et cetera, to buy time, buy room, buy down debt, et cetera. So with that, I'm going to finish up for today. As always, thank you for joining me. If you like these updates, check out FFTT-treerings.com for more information about our tree rings product, 10 most interesting things, brief synopsis on what grabbed our attention about them, and as I noted before, whether it's reinforcing or changing a way we'd previously been thinking about the world. So as always, thank you. Everybody have a great rest of your week. Look forward to chatting with you soon. Take care.